I had the misfortune of renting a house in Bangalore for, I think, what was it, 6 or 7 years. And here's what I learned about the process. You met your landlord, you agreed on a rent, and then just when you were about to close, they reminded you that you also had to pay something like 10 or 11 months deposit. When you offered someone a salary, or when you chose to accept a salary plus ESOPs, how did the two intersect with each other? Was it like how my landlord basically extorted me and said, well, this is your salary and the ESOPs are extra? Or was it the other way around, where the person was like, let's accept a lower salary and get some ESOPs on the side?
When employees accept that risk of taking maybe a little bit less pay, what they don't realize is if things work out, it's probably the only significant equity exposure they'll have in their lives.
I think the big game changer was 2018 when Flipkart was sold to Walmart, and roughly 75% of all non-founder ESOPs were cashed in, which meant they actually got a truckload of money from Walmart.
I have an ESOP and my company is doing well. People keep saying, hey, do you want to make some money off of this? How do I think about that? Who's the other person who's giving me money?
ESOPs are not shares until they are converted to something.
A lot of companies have ESOP plans which say that before an IPO, all the options have to be converted into shares. There is an IPO happening. How do these people, maybe you have 10-20% pool for the ESOP, how will they convert this? Because they will all have to pay tax. Where is the cash to pay that tax?
So let's say you've got lucky and you've managed to get a fairly good payout through your options in one of these companies. And now you're sitting on this cash, or maybe some shares of the company public and cash. How do you invest this? Hi everyone. In today's episode, we're going to take a look at stock options. In particular, employee stock options, or ESOPs as we like to call them, the abbreviation for employee stock option plans, that we've had quite an interesting ringside view to running our PMS for the last, 7 or 8 years. In the initial years of running our PMS, Capitalmind Wealth, we had customers who had just made money out of stock options and were using that money and trying to figure out where to invest it, and had perhaps come across us and were hoping that we could manage it for them. In the more recent years, we've had employees, people who've been customers of ours for many years and have now seen their companies go public or are about to get acquired and now need to withdraw a small portion of their PMS accounts to be able to fund things like taxes and exercise prices for the options of their companies that are about to go public. So it's in this spirit that we thought we'd bring in Deepak and Vashishtha to take a quick look at stock options. We've had some experience with this ourselves, with some of our early employees selling their stock options recently. And so we wanted to go deep into this topic and take a look at what stock options are, how you should think about them, where they stand versus salary, how do you value a stock option, and then finally, when you sell a stock option or all your stock options and have money to invest, how should you invest it, given that one of the bets of your lifetime has already paid off? So do listen in. Folks, I had the misfortune of renting a house in Bangalore for, I think, 6 or 7 years. And here's what I learned about the process. You met your landlord, you agreed on a rent, and then just when you were about to close, they reminded you that you also had to pay something like 10 or 11 months deposit. And that was just norms in the city. This, of all things, actually got me thinking a little bit about today's topic, which are ESOPs, employee stock options, and in a sense, how they relate to salary. So at one point of time, we were both on different sides of this table, one as an employer and one as a potential early employee. And so I just wanted to get both your views on this. When you offered someone a salary plus ESOPs, or when you chose to accept a salary plus ESOPs, how did the two intersect with each other? Was it like how my landlord basically extorted me and said, well, this is your salary and the ESOPs are extra? Or was it the other way around, where the person was like, let's accept a lower salary and get some ESOPs on the side? So either one of you could take this. Maybe I'll start with Vashish, since he was the one who had to make this decision. So how would you think about it?
Depends on at what time you're joining a company. When Deepak and I met, that was 2015. So the company was barely 1 year old. At that time, there's not much money to be paid out in salaries anyway. And there's not no guarantee or no track record of the company working. So you're taking a very big bet whether the company will even work out or not. And so at that time, I think typically if you're a very early stage employee and the founder is looking to build their core team, you'll probably offer more in options because there's not enough money to pay for salaries. So people who join earlier kind of giving up on maybe market rate salaries, taking a haircut, and then accepting the risk of building the company and being compensated in options for that. Well, that's for early stage. Once it becomes a company which has cash flows, it's a legitimate business, there's product market fit, and so on and so forth. At that time, the conversation will change. Then your ESOPs are like currency, and especially if there's a secondary market for those shares, it's certainly very much a currency. And if you're a public company, it's very liquid currency, right? So then the conversation will change quite a bit, because then you're also in a place to in a position to pay market salaries, and then the options become more a tool to align incentives and to also offer an upside. But it's more management of incentives and alignment of interest rather than anything else.
So Deepak, I don't think you've ever really worked for anyone else as an employee. So I don't think you can inhabit that point of view. But tell me, how do you think about this topic? I mean, it's changed very dramatically over the 10 plus years that you've been running Capitalmind. How do you think of salary ESOPs and this
Yeah.
one?
I have actually I think I made made a little bit of money with ESOPs in 2007 or so, when I was at Flowweight and we sold the Indian arm of the company in that sense to WNS. I made a little bit of money through ESOP, so I saw the value of it because it was significantly higher than my annual pay. I mean, at that time. But I think to that extent there is a disconnect here, because when I joined that company, it was a relatively small salary for, I mean, small salary for the company, but relatively large for me, because I came from a startup point of view where I was saying, this is great, this salary is enough. If I make nothing from the ESOPs, I'm still quite comfortable. So I'm not giving up anything to that extent. However, when I think of ESOPs as an employer, I think the idea of this should be very simple. I can't afford to pay you, so I would rather give you a piece of this company, and if you make it up big together, you will make a significant jump on whatever I could have paid you now. So for instance, if I can pay you 10 lakhs today, I think the 10 lakhs should be worth, I don't know, 50, 60, 70 lakhs at least, for it to be meaningful for you to take a risk. And saying, why should I take a risk of not taking 10 lakhs in salary when unless you show me something that can give me 50 or 60 lakhs tomorrow. So it's like it's almost like me saying, please invest your 10 lakhs which I didn't pay you, and somehow I will return you 50 to 60 lakhs later, which is something that you cannot get from any alternative investment. So if I paid you 10 lakhs today, you pay tax on it. That tax, post tax money would get invested, maybe 6 lakhs. 6 lakhs gets invested over 10 years, maybe becomes, I don't know, 60 lakhs.
Of course,
Not
10x, of course.
10x.
Yeah.
Well, okay, in the market, you'll probably get only 5x. So let's say you get 5x or 4x in 10 years, which is 14% a year. Your 6 lakhs become 24 lakhs, right? So instead, if you say that if I can make that 10 lakhs worth something like, I don't know, 60 lakhs, you're almost looking at that and saying, oh, I'm getting a 6x, where I would have got a 2.4x, I mean, 60 lakhs post tax, which is probably 1 crore. So I need to still grow your money. So then what I would do is I would think about it and say, what am I going to value the company at today? Let's say I value the company at 5 crores. At 10 lakhs, you get 2% of the company. And that 5 crore investment, maybe I'll raise some more money and all that stuff, you'll get diluted a little bit. Maybe this company is worth 200 crores and now you have only 1% of that company. So because you got diluted 50% or so, now the 1% of 200 crores is worth 2 crores, which is a 20x return on the 12. So then I have kind of fulfilled my part of the bargain, but saying, listen, I've made it worth more than if I had paid you that cash upfront, which I couldn't have anyways, but you took that risk, and that 20x is now yours, which is great. So that is the way you kind of look at it from an employer's perspective, saying I can't pay. And from the employee's perspective, it's almost like, yes, I'm willing to take this risk because I can see this greater return in the end. Unfortunately, in India, what has happened is over the long period of time, you've had a situation where ESOPs they were not even gravy; they were just things. So you ended up with this thing of saying, oh, maybe it'll make some money, maybe it won't. There were lots of examples of companies which just died without. Lots of examples of companies which were acquired, but the ESOPs themselves didn't do anything. So what they did was they just took the ESOPs and said, listen, we've acquired your company, but you know what? We're not going to pay you out for the ESOPs. We're just going to give you new ESOPs in the new company. So an Oracle would buy you and give you ESOPs of Oracle. So whenever that ESOPs of Oracle would kind of mature, you weren't thanking your initial company, you were thanking Oracle, because you kind of, you've moved. So you're not valuing ESOPs meaningfully at that point. You're not thinking of it as compensation. And I think the big game changer was 2018 when Flipkart was sold to Walmart, and roughly 75% of all non-founder ESOPs were cashed in, which meant they actually got a truckload of money from Walmart. They didn't get Walmart stock options; they just got money. And now suddenly they were like, oh, wait, this thing that you told me that was part of my compensation package, which I valued at zero till now, is worth something. So that's when things started to move around and said, oh, well, you know what? Other companies started looking at this and saying, listen, they got paid, so maybe you will too. And since then, we've seen companies like Zomato list and Swiggy list. And in Zomato, if you look at just the shareholders that have sold their shares, which are relatively higher top management people, some of them have made hundreds of crores effectively, even after paying up for the options and all that. And that is something that is a remarkable achievement, because earlier it was only the founders who would make all this money, right? So now, if you've got employees making hundreds of crores, not tens of crores, but hundreds, then you're like thinking there is some meaningful, reason to have ESOPs. So it is possibly now an instrument of compensation when earlier it was considered a lottery ticket, like,
Just maybe.
just maybe, yeah.
Two underappreciated things here is, one, when the founder in an early stage is creating an ESOP pool, is basically he's diluting himself or she's diluting herself. So the founder, imagine the amount of money they are leaving on the table by diluting themselves to create that ESOP pool. Because if things worked out, it's all that money that goes to the ESOP pool would have been theirs. That is one. The other is when employees accept that risk of, taking maybe a little bit less pay, but accepting ESOPs as payment. What they don't realize is if things work out, it's a significantly concentrated bet they're making. It's probably the only significant equity exposure they'll have in their lives. For most people, I think most people don't go and buy portfolios of 5 stocks, right? And even if they did in the public markets, they probably participate through a mutual fund or maybe buy a diversified portfolio and so on, where you will get 15, 20 CAGR or something like that. This is like 95% of your net worth essentially locked up in an ESOP. And that, if a private company does well, your CAGR can be 30, 40, 50, even 100%. So a very concentrated bet, equity bet, that can grow at a very high rate is what an ESOP eventually is. That is why you see these people making so much wealth from it, because it was a concentrated bet that they took.
I'll just add one example, just to flesh out the example a bit better, is I do know that while perhaps in Bangalore, ESOPs hadn't paid out in many of the years leading up to 2018, I did have friends at HDFC, the mortgage wala HDFC, who were making steady money on their ESOPs every year. And additionally, I think a few decades ago, Infosys had made a lot of people money, maybe in the 90s, I guess, on ESOPs as well. But yes, I guess these things need to keep being renewed as examples for everyone.
It's interesting because both of these companies started to give out their ESOPs after they were listed for the most part. And that created a lot of, it was different because I could see the price and I could liquidate at this price. Whereas in a startup, there's no price and there's no liquidity. So you're almost taking a blind bet on some future. So it's a slightly different incentive. But I would say that is also true now of established companies which are yet unlisted, because now they have all these VCs and some demand and all that stuff that is somehow giving you a price tag. Now there are portals that have secondary shares, people who have ESOPs who want to sell those ESOPs to other people who want those shares, but there is not actual listing somewhere else. So they can actually say, oh, well, you know what, this ESOP is actually worth so much. So you can put a rupee number to it. So a little bit different in that sense. But yes, ESOPs have made people rich for ages in India as well. I have a friend, a senior of mine, who told me in 2000 that he had retired with ESOPs worth crores, and he was spending his time. He had left in fee at the time, I think, and he started to go to the flower market in the morning just to see if he could lend money, and apparently the lending rates were as much as 100% a day. And for him to experiment with what is this 100% a day phenomenon. So, I mean...
Does he still have the money or...
Well, I suppose since he's not one of the top billionaires in the world right now, I would imagine that he stopped that business very, very quickly.
So, small note on that. If it works out, you have already made the highest return you'll ever make from an investment. So, then you probably either you go on and keep taking more risk by becoming an investor in other companies, or you go into wealth preservation mode and invest it more sensibly in a more diversified way.
So park that thought. I'll come back to that actually at the very end. But I wanted to come to the point you guys both have just touched on. So fine, you are said employee or said employer. There are options allotted to a single employee. When does this employee get to sell these options or see money from them? And I have a few questions around this. I mean, both of you can take it however you wish. But who are they selling this to? Are they selling it? Is the company buying it back? When they do this, are they going to be paying what tax? Are these capital gains instruments or not? So I think that's really my question. I have an ESOP and my company is doing well. People keep saying, hey, do you want to make some money off of this? How do I think about that? Who's the other person who's giving me money?
Okay, so I think we have to consider that ESOPs are not shares until they are converted to some. That means there are options that say, well, you can convert it to share if you pay a certain price, and we talk about the specifics. But if you pay that price and convert them to shares, they can sit as shares in your demat account. That means they're actual shares. They give you voting rights, etc., etc., etc. But the income tax department understands the difference between these two. So they say that it's the minute you exercise your options, you have a taxability as if the market price was today. You actually bought those options today at the current price, but because you paid a lot lesser for it, that difference is also compensation to you. So you have to pay tax on that difference in terms of compensation. So you got the ESOPs at 10 rupees, but today's market price, whatever for whatever reason, is 100 rupees. They would say 90 rupees is your compensation that the company could have earned had it sold to somebody else. Therefore, we're going to consider that that's a compensation to you, and you have to pay tax on it. So 90 rupees into 40%, let's say, just to give a number, 36 rupees is what you have to now pay to the income tax department. 10 rupees is what you have to pay to the company. And you can technically take that money, exercise it, and sell it to somebody. Now, exercise just means I have bought those shares. But if there's a buyer, I can sell those shares as well. Typically, in the life cycle of a company today, there are liquidity events. And that liquidity event at the extreme is an IPO or a sale. I mean, somebody comes and buys all the shares of the company and says, oh, you ESOP holders, I will give you money for your ESOPs. And whatever ESOPs are vested. So you have the concept of vesting. So you have an ESOP may be granted over 4 years. So you can say 25% of that vests every year. So in year 2, I have maybe 50 shares vested, 50 shares unvested. A company comes and buys my company. They pay me for the 50 that's vested, but the remaining 50 that's unvested are maybe translated into ESOPs at the new company. The money comes in then. That's the liquidity event that you're talking about. This is where you may or may not make as much money as you thought. Simply because let's say a company came and bought your company and said, you know what, we invested in this company. I mean, some VC said they invested in this company at $100 million and your company got sold for $120 million. You would think that, you know what, this is great. The VC put in, I don't know, some money. Maybe they put $30 million at $100 million valuation. They own 30% of the company. But there's some fine print in that thing that said, you know what, we'll first take our 30 million back. And then we'll take 30% of what's remaining as well. So in the end, what you're supposed to get, which was whatever calculation you did on 120 million, turns out to be a much smaller number for whatever reason. And that kind of goes away. So that's another area where your liquidation may result in a lower number. In many cases, if the company is sold at less than the valuation at which it was last valued at, you might actually get nothing. We've seen that in companies, in cases like ClearTrip, for instance, where there was an exit value, but ESOP holders saw nothing or very little of that value. The second bit, and that's getting more popular now, is you're watching companies grow up. You're watching them not being listed at the same time. And you're saying, I want a piece of this action. I want to be a part of this company even before it lists because I think I like the future of this company. So you go to the employee and say, you know, you got ESOPs? I'm willing to buy it from you for some value. And that value could be, I don't know, 200 rupees a share. The company was last valued at 100 rupees per share. And the employee might look at it and say, you know what, I have a lot of options. I can sell a little bit for 100. Why don't I, for 200? Why don't I do that and get some liquidity? This is now possible. And it's not just possible one-to-one. It's possible through these intermediate platforms that seem to have come in, okay, quasi-legal perhaps, because SEBI has a lot to say on something like this, but SEBI is actually creating something called a pre-IPO platform, primarily to address the fact that people want to be able to sell their shares before they actually go IPO on a one-to-one basis, in the sense of, oh, I want to sell to Shrey, where does SEBI want to talk to me? I'm not advertising that I'm selling my shares to the whole world, and Shrey is not advertising to the whole world that he wants to buy my shares. So there's no marketplace per se, it's one-to-one. So what's the problem? So this one-to-one can still be stitched together by a one-to-one marketplace, which is restricted to only some certain kinds of buyers and sellers. But this effectively creates another market for you to be able to get liquidity even before the company is listed, and maybe even partial liquidity, and that slowly gets you some money for the ESOPs that you thought were earlier of very little value. So a lot of companies, people are usually surprised when they find out this company that they worked for like a year and a half and gave them a few options suddenly has this massive value that they never even thought about. In the case of, for instance, I think it was some of the IT companies, and even in HDFC and all that, you've seen people who have just been there for a long time, not spectacular. Sometimes the driver of the founder, or we've seen that was a person who made crores because they got a very small portion of the shares at a time when the company was very, very little, and that company became 1000x more valuable. And their little portion of this little tiny company became a little portion of a very large company, which is still crores. So that, I think that impact kind of comes to you later down the line.
A lot of this pre-IPO market is happening also because ESOP plans are worded differently in different companies. Some companies say, look, if you are exiting as an employee, then you have to convert your options into shares or they will lapse. Some are nicer, like we were, which don't let ex-employees options expire like that. And what happens in that case? Because you have to exercise. Now you're forced to exercise, which means you have a very large tax bill. So because
Deepak was talking about that. So it's taxed as a perquisite, right?
Yes.
So that doesn't sound very happy.
It's income.
Okay.
And if depending on your slab rate, but let's say you're at the highest marginal tax rate and you're going to get taxed at 39%. So if say you're in a very early employee, you got ESOPs at the strike price of 10 face value, and now the stock price is say 500, right? And now if you try to exercise, 490 is your perquisite, you'll have to pay tax on that. So how do you bring that cash? Because you will have to figure out that cash if you're forced to sell. Now this pre-IPO thing, a lot of companies have ESOP plans which say that before an IPO, all the options have to be converted into shares. Right now, if there is an IPO happening, how do these people, maybe you have 10-20% pool, which is for the ESOP, how will they convert this? Because they will all have to pay tax. Where is the cash to pay that tax? So you need secondary buyers to come in who will provide that so that you exercise and sell immediately.
Can't the company just give a loan?
Company can give a loan if it has the cash. But if it's going to the market to raise cash, then why are you loaning it to your own employees to exercise these things and so on?
Essentially loaning the government money. I mean, that's you're paying, loaning it to the government to pay it. But there's another downstream impact of this is that people don't need to. So you have this concept called accrual taxation. So let's say instead of ESOPs, I just said, I'll give you a bonus to buy the shares today. So if you take 10 lakhs rupees worth of shares, I'll give you 10 lakhs as a loan. Now what happens is that 10 lakhs as a loan is still taxed. So you get 6 lakhs in the end. You buy 6 lakhs worth of shares, and the shares go up 10x. Now, 6 lakhs worth of shares goes to 60 lakhs. You're thinking, this is great, but you're going to pay tax on 54 lakhs as well, which means that's the income tax on long-term capital gains, which is 12.5%.
Well, it becomes 15 at high brackets.
15, yes, yeah. It becomes 15. So if you're paying on 55 lakhs, it's about 7.5 or 8 lakhs of another taxation that you're paying. Whereas if you don't pay this bonus at all, and the person doesn't actually exercise it, he's got 10 lakhs worth of shares, it goes to 100 lakhs. So because it's the same 10x, 1 crore. And then you say, well, you know what, now you can exercise it. Even though it's a perquisite, I pay 40% tax, I still end up with 60 lakhs post-tax. There's no tax on that accrual that has happened in the intermediate. So this is actually beneficial for the employee to not exercise at intermediate points just in order to for purchase the shares and keep them as they are.
Because if you exercise, you pay the TDS, right? And if you try to do like a cash neutral exercise, say you sell some of your shares and use that cash to then exercise and pay the TDS for the remaining. What happens? You're left with fewer number of shares. So now you're compounding at a smaller base. Well, it makes sense that it's fine, but sometimes it does make sense. If you are a very large holder of ESOPs, somebody say has 1, 2, 3% of a company, right? And you expect the company to go up 10x. What happens? Eventually, your shareholding may be 100, 200 crores. If you want to then exercise at that time and the company is not going public, it's maybe getting acquired, right? So at that time, your tax bill will be, say, 80, 90, 100 crores. So how will you get that tax? How will you get the cash to pay that tax? It's not going to be possible.
Yeah,
So you should exercise when you can afford to do it.
the buyer could actually say, listen, I'll pay you only if you have shares, and please convert your
Yeah.
ESOPs to shares. And the company is going to be like, we'll convert your ESOPs to shares if you pay the tax, because the perquisite tax is payable by the company, not by you.
It's a TDS.
TDS. It has to be tax deducted at source. So now you have to find 100 crores to pay the company. The company will then take it and convert it to shares. There'll be a 15-day, 20-day period of when this happens. And then the acquirer will come and buy your shares. Usually they make these transactions happen in some way, but you could get into a tizzy where a situation like this, and I've seen this happen in some companies where they said, we'll only convert the shares. If you have ESOPs, we'll just translate them to ESOPs of our company. And I'm like, no, I want money. At this point. So like he said, he's right. You should do some of this for sure, because otherwise it's going to unnaturally increase your overall capital gains.
Yeah, because on paper you will have a lot of money in your worth, but then there's no way you will be able to exercise it.
But this feels like it should be a solvable problem. I mean, can't I push back saying both of you have given a very extreme example where this hypothetical
It's
person
not
has
extreme, because it's also not just a TDS. There's also counterparty risk. Because you may have a buyer who says, okay, fine, I'll do it. And you, based on that commitment, you have gone ahead and exercised your options. But how does the process work? You send an exercise notice to the company. A company says, okay, fine, pay me the exercise cost, which is the number of shares into the strike price, plus the TDS that is applicable. So you have to transfer both the TDS and the exercise price, right? And then you transfer both of them. Then the company will allot the shares to you. It will take about 2 weeks for the shares to get credited to your demat account. And then you will have to get the payment from the buyer, and then you transfer the shares to them. It takes a while. In this interim, what if something happens to the buyer? Or the buyer says, no, I'm backing out, for whatever reason. And or they're usually in a share purchase agreement, there are many conditions precedent. They can cite any of those as a excuse, saying, no, this is not as per what we thought it would be, and hence we are not going to go through with this. So you have counterparty risk. Now the tax liability has arisen the day you have exercised your shares and you were allotted them. So even though the shares are not even in your demat account, the tax liability has already arisen. You are now on the hook to pay the government that tax, and the company has to pay the TDS, which is why it is collecting it upfront. And then, so the counterparty risk is very real. So in a small, if you say it's a 1, 2, 3, 4 crore thing, maybe something that you can manage, it's still fine to take that counterparty risk. But if you're holding on to 3, 4, 5% of a company and expecting that you'll only sell when it hits, it's a very large valuation, and that your worth is 200-300 crores, you will have that very big counterparty risk as well.
Fair. I know in public companies, at least the friends I was talking about earlier, they were able to get short-term loans from, maybe it was Bajaj Finance or something, maybe because the stocks they were exercising.
Yeah, NBFCs will give you a loan to do this. Again, but it doesn't avoid the counterparty risk.
And second, almost from a philosophical point of view, shouldn't this be the company's responsibility to sort of help shepherd the employee into getting the liquidity? Because you are an employee, as sophisticated as you may be, and I would think most people don't end up with percentage points of ownership at IPO or exit time, right? I mean, that's a very, very rare situation. But you've been working hard for this company for presumably many years, and now there is some success outcome. Doesn't the company have some responsibility to sort of help make this happen for you? Or is the problem that the company's hands itself are tied? And this
depends on how the company is getting the liquidity. If it is getting acquired, then it may have limited choices, because the acquiring company can say, look, I'll only pay you in my shares, and I'll only pay you enough cash to pay your tax. So that happens very usually, and this is the most common acquisition that happens. And the company that's acquiring, it may have inflated its own stock price in a recent funding round. So it's diluting even less of their company to acquire your company. So that happens very usually, that we have seen.
Doesn't the company owe you? No, I think that's enough.
Yes.
You've given. He's
Yeah.
given the answer. We can move
I'll,
on.
I'll, I'll, I'll add a little layer to that. And the reason why I think what Vashish mentioned was when companies acquire you for stock, they actually give you their stock. And this time, sometimes it's unlisted stock where you can't even exercise when But if I have 100 shares of ESOPs and I haven't exercised them, the company can say, listen, your 100 shares are valued at 6,000 rupees. So I'll give you 6,000 rupees worth of my stock at whatever current valuation I have. You're thinking, well, you know what? But the income tax looks at it and says, well, you got something of some value. Therefore, there is an income tax application. So you got 6,000 rupees worth of value. So I'm going to consider that you got 6,000 rupees worth of compensation. So you're like, wait. He just converted my ESOPs to 6,000 rupees. Where's the money? So they say, well, okay, you know what? We'll give you 4,000 rupees worth of shares and 2,000 rupees worth of cash compensation so that you can pay for the 40% tax on the 4,000 rupees of this thing. So you get a bit of this and bit of that, and post tax everything is blah blah blah. So at this point you might be like, okay, I have sold some of my shares for 2,000 rupees. I have got new shares worth 4,000 rupees, and that's how the equation is worked. That's one of the reasons why some of the recent acquisitions have been a little flummoxing, because the VCs made all the money, they got all the cash out. But the people who were founders and the early employees and all that simply got shares of the new company and only enough cash to pay the tax. So essentially, you're not richer in terms of actual money. So you just now own shares of another entity, which is perhaps can or cannot be valued at whatever number. It's the private company that's just, and everything's all right as long as there's liquidity, somebody else willing to buy those shares at some price. But if you find that there's a downturn of some sort, suddenly your shares are not just illiquid, they're worth zero because nobody's willing to buy. I mean, you get, let's say, I give you an example of maybe a company like Byju's. It was fabulous, fantastic, great
Apparently,
run.
they didn't really give people options, though.
Did it?
I've heard.
Yeah,
But okay,
okay.
but let's run with
Assume
as
you
if they
did.
did.
Yeah, assume you
Probably
did.
did everybody a favor.
Yeah, I mean, honestly,
Because you could if you could be a very optimistic employee and very bullish on the company and say, okay, let me pay the TDS and convert my shares and convert my ESOPs and keep them as shares. And then and this has happened to some friends of ours, right? They exercise at I don't know, something that was going public. They exercise at $20 and now it's down to $3. So they've paid a tax at the $20 price, but they're now sitting on an asset which is $3. So you could end up with those situations as well.
We've been talking. So actually, we should clarify. The ESOPs is just the word that I think is just used colloquially. Actually, it's just a stock option. The P is the plan in the abbreviation. But let's look at an individual stock option. What are the parts of it? How do you value one? So there's a strike, there's a market price or a current price, FMV perhaps. There's an expiry. You're supposed to use a volatility, and then there's a prevailing interest rate. Could you just talk about all of these and how they feed into like the option value?
Yeah, let me quickly say this. Let's say I have a company. I started Capitalmind with 1 lakh rupees, but then I built it up. I had some revenue and all that stuff. There was a point at which I had to value it in order to raise more capital. And let us say, and just for the argument's sake, I decided to say that it has a value of 5 crores because of whatever reasons and bunch of things. And people agreed with me and said, okay, I'll put money in at the valuation of 5 crores. Now I want to make it an ESOP plan to employees who I want to hire or are already on my table. And I say, listen, here's the thing. I'm going to carve out, say, 5% of this company for ESOP. So this company is worth 5 crores. So 5% of this company is 25 lakhs. Actually, what an investor would insist is you create this option pool before you value the company. So it should be 5 crores, including the value of this thing. So it's 25 crores, 25 lakhs is kept as an option pool, and the remaining is whatever. And perhaps the investor puts in another, say, 50 lakhs in this. So they own 10% of the company. The promoter owns 4.74 crores, 5 crores of the company, and 25 lakhs is left to employees as options. I take one employee and I say, I'll give you 5 lakh rupees worth of options. Now, what am I doing here? I have, let's say, to make it simple, I have 1 lakh shares in this company, and I have created 25, not 25, to about 5%, so 5,000 shares. So 5,000 shares have been kept for employees. Each share is worth 500 rupees, just as an example. If each share is worth 500 rupees, then if I give someone 5 lakh rupees, then I'm actually giving them 1,000 shares. So I give them 1,000 shares and I tell them, out of the 1,025 to 250 will vest every year for the next 4 years, and you will kind of get this. And now you're thinking, what does this even mean? Now, what I'm saying is this company has already got a value of 5 crores. You're joining today. So you actually get something worth 500 rupees today per share. I'm giving you 1,000 shares, so it's 5 lakhs. I could choose to say, I'll give you these shares worth 500 rupees a share at 10 rupees per share.
So what's that 10? That's
The 10 rupees is called the strike price. So you're getting the option strike price of 10. And it's actually worth 500. You can't sell it, of course. But I have managed to sell it to somebody at 500 rupees per share. So it's actually worth about 490 rupees per share extra. No tax for you because you haven't exercised anything, you haven't done anything. There's a vesting schedule and then there's an exercise time frame. After it vests, you can exercise it by paying me the 10 rupees and taking the share into your account. But whatever the market values are, today it's 500. When you vest and you decide to exercise, it could be 1,000. So between the 10 rupees and the 1,000 rupees per share is a perquisite that you'll have to pay tax on. That is the strike. So and then there's a time period. So it says, oh, well, your maturity date is 1 year from now, 5 years, or whenever the option pool matures. Typically, you'd say a 5-year or 10-year period after, but you can't do more than 20 years in Indian law, I think. So you kind of do it as much as you can. But usually companies say that, listen, if you leave the company, whatever you vested, you need to either exercise it within 6 months or leave, which means...
or forfeit.
Or forfeit, yeah. So forfeit means that those shares go back into the pool and, it's no longer available to you, which typically is not done by someone leaving. And why do they not do it is because I'm leaving this company. I don't think it's a great company. That's why I'm leaving it. And when I leave it, the shares that I have, I'm going to have to pay you money to buy it, the 10 rupees. Plus, I have to pay the perquisite tax on whatever else it's valued.
I think it's the perquisite tax. If it was only the exercise price, I think a lot of people would have converted and kept shares. But it's the tax that is a big deterrent.
I wanted to work through the math on these. So can you tell me what these... So there is a... So you were able to define the FMV or the market price. I'm trying to relate this to just like a stock option when you use, say, the Zerodha Black-Scholes calculator online. So each of these terms correspond to something in an employee stock option as well, right? So the market price is the...
is the FMV,
is the
market
FMV
value.
of the company.
Which has to be given by a merchant banker or a registered valuer.
There we go.
1 lakh rupees, by the way.
Gotcha. Probably more, I think.
1 lakh minimum per, and each time you value it. So if I do it every year, then 1 lakh rupees a year is what I have to pay.
Well, that doesn't sound horrible in that sense. But then the strike you've already defined. It's what I have to pay to exercise my option. The gap between them you've already mentioned is a perquisite. But in that Black-Scholes tool I see online, there's a couple of other parameters, right? I have to figure out what's the interest rate, what's the volatility. So what should I use for this?
So the options price. So what you were talking about, the employee's perspective, or what is it that they are receiving and what is the tax. From the company's perspective, there is an expense. And that expense is to the extent of the price of the option. Now, that is where this Black-Scholes comes in, and you calculate what the price is going to be. And the price is very sensitive to the interest rate, not as much to the volatility. So in the Zerodha calculator, for example, Black-Scholes calculator, the spot price will be your FMV. Your strike price will be your strike price. The expiry date will be whatever you choose to do. Typically, it's 10 years, I think, in India. The interest rate could be, if it's a 10-year, then you take the 10-year maybe GSEC and use that as the risk-free rate.
So that's like 6 or 7 right now.
Yeah. And volatility, it is not very sensitive. You can choose whatever you want. Maybe you take the benchmark index and then double it or triple it and say that since a private limited company, the volatility of stock price will be much higher than the public benchmark. So you take those numbers, you put the things and so on, and you'll get a stock price. Options price. That options price is your expense as you vest. Not when you grant the options, but as they vest. So say, for example, if you gave somebody 1 lakh shares, 1 lakh ESOPs, and it vests 25,000 per year. So every year, 25,000 into the option price at the time of grant. That will be the expense of on the company's book. Now, here's where it becomes interesting. if you give somebody at a strike of a very small strike, so example, say at face value, so you give somebody when this fair market value is 500, you give somebody a strike of 10, the cost to the company is almost the entire stock price, because it's so in the money that the option price is very close to the spot price. So the bigger expense for the company, and you're also so at the same time the company is taking a big expense on its books, it's also rewarding the employee for all the past growth. So you must really want that employee to making them happy to do this. In a more evolved or a more mature company, the strike price will be the at the money price. So it will be an at the money option. So you'll give it at the current market value.
Or marginally below that, I guess.
Marginally below, marginally above, because then it's a question for the company that how much cost do you want to incur. You can also make it out of the money. Saying, look, I know that you're joining today, but there's already some, there's some momentum in the company and we'll anyway hit 20% higher price because of the work we've done so far. So your contribution starts only after that. So the strike I'll give you is maybe 10-20% out of the money.
So, Deepak, this stuff is fairly complicated. Why don't we consider alternatives like, I don't know, just like doing a contract for difference type thing, like a stock appreciation right? Or actually just giving the person shares and being done with it. Isn't that easier for everyone?
It is, in fact, in a lot of cases, it could be. But the problem is, if I give someone shares, the company is actually valued at 5 crores. I give them 5 lakh rupees worth of shares. They would have to pay 40% of that.
But they've not sold anything.
The act is I have given them shares worth value. And options is considered value, but it's not considered value in the hands of the employee until it vests.
No, until
it's exercised. Yes. So therefore, I can defer the taxes on that. But if I gave you actual shares, I would have to immediately make you pay a tax. And to make you pay that tax, you have to pay a tax of 2 lakhs. And you're like, I'm not going to pay 2 lakhs. To get you 2 lakhs, I have to pay you 3 lakh rupees in compensation, because the 3 lakhs itself is tax. And technically, so in the end, you're like, you can't do this. So one of the problems is that. Second level is companies don't have the cash. That's why they want to use stock-based compensation. So in effect, your stock is your currency. And you're trying to use that currency in a most tax-efficient manner. That's why the ESOP exists. Otherwise, you do different things. For instance, I could do an RSU. An RSU would be great if I was a public company. I would say, listen, we have a public company. Its shares are valued at 150 rupees per share in the market. So guess what? Every month, you get 500 shares. That translates to 75,000 rupees of compensation, on which we will deduct this RSU tax, because 75,000 is value you're getting as 40% or something
from the rest of your salary.
From the rest of the salary, and with whatever's remaining, I'll give you that many equivalent shares. So it's like saying, instead of giving you 75,000 rupees worth of shares, I will give you something and then deduct 40% of that, and then whatever's remaining, I'll give you that many shares. This is how American companies operate, where they reduce the RSU taxation from the shares available and then give you correspondingly lesser number of shares. Many of them operate in that perspective. Others do something like, listen, you're going to get a bonus once a year. In that bonus is going to be high enough so that I can give you all the RSUs at that time. So I'll give you the RSUs, deduct the bonus taxes from your bonus, and net you'll get something really tiny as a bonus, but you get this massive wad of shares to pay to be able to exercise. Now, why is it useful? RSUs are for liquid companies where you can actually sell on the stock market. So technically, you could sell it whenever you want, and they are not a cost to the company at all, because they're issuing you shares at the market price to that extent. So the additional thing that you have, that the way you can compensate, is by stock appreciation rights. Now, Saregama in India did that, where they hired a CEO who they said, what, the share price is X, and if it goes to, I don't know, anything more than this, we will pay you. Tesla, Elon Musk said has a compensation package now that says, well, you know what, if you take this share market cap from $1 trillion to $8 trillion, we'll give you $1 trillion worth of shares. At that time, 15% of the company is on that. This is great because it's entirely dependent on the appreciation that you get, and sometimes it's more linear. Here it's binary, saying get to 8 trillion or not, versus you can say, for every $100 billion increase, I'll give you equivalent 10% of shares. That would be a stock appreciation right. The problem with the stock appreciation right is you're not getting shares. You're getting the value of the difference in market cap. Now, if some crazy operator decided that your share is worth punting on and takes its price up to an extreme, and somehow it lands up at 10x its price. Suddenly, the company has to pay for no gain of its own a reward based on a 9x increase in, 9x or whatever the price was, to the employee as cash, which is not shareholder friendly, because the shareholders are like, yeah, fine, I got this share price increase, but tomorrow the share price could fall, and it would be again of no fault of the company. The company didn't do anything meaningful to increase that share price. So why are we paying, or why don't we just give this guy shares and he can sell in the market if you want, but why are we paying them a compensation just based on the increase of price in the shares? So the fact that you're not diluting the company anymore, instead paying cash, works greatly for cash rich companies perhaps, but even there I would say just issue the shares instead, or give RSUs rather than giving share price based compensation. That just, I think is not as effective as it forces me to, as a CEO, to start making announcements that just about increase the price just about when I come to a point, like this is March 31st. On March 31st, on 30th, I can go to this thing and say I'm acquiring, I don't know, Time Warner, which seems to get acquisition offers quite a bit. So
every few decades.
every few decades, yes.
Just one quick follow-up and then we'll just go to it. In India, promoters are a big deal, and directors. Can promoters and directors get, I don't know, either stock options or other stuff like this?
Unfortunately, no to promoters. And as a promoter, this hurts me to no effect, but I cannot get any stock-based compensation in the form of an ESOP. The ESOP, since promoters are not allowed to own ESOPs, it becomes a big problem for not just people like me, but also for promoter families, where the family has owned the stock for the longest time, and they want to incentivize someone young who relatively owns a small percentage of this company to come and run this company, because he's part of the family, he understands, he's part of the the control of the company. They want him to be part of the management, and he's really capable. We have seen this in a lot of family groups. Unfortunately, because you can't give this person ESOPs, and if you removed him and placed a professional CEO, that person can get ESOPs. It's not equal in that sense, but because of that, they have to use different instruments. So one of the things that they use is warrants, where promoters get to say, well, I'll buy the share, but I'll buy it within 18 months, and I'll put 25% cash down on this warrant. And that's actually shareholder friendly, because it allows the promoter also to get kind of a stock option of sorts, which I think is fair. But also there is another area called a partially paid share. Now, this only makes sense for mostly private companies and small companies, where if you're designated a promoter, you will not be able to get ESOPs, but you can buy a partially paid share by paying part of that value every year for say 3 or 4 years. This is useful when you want to reward a promoter for incremental work, because the promoter is like, listen, I've already done this work till here. Now we could hire somebody else and you'd have to dilute anyway. So why don't you give me a portion of that dilution? Perfectly fair to ask as a promoter. But I think at the same time, you don't want this to get out of hand. However, you can use a partially paid share as but there are lots of, you could use it, but there are lots of ifs and buts when you use it in public limited companies. They don't like it. They don't like preferential issues of partially paid shares only to the promoter. They'll be like, well, if you're giving a partially paid share, why don't you give it to me as well? That's how public shareholders would think of it. So there it becomes more complicated. Directors can. So directors, I think there's only one rule, that any single independent director cannot get more than 50% of the compensation of all the directors put together. It's for non-executive directors. Executive directors are fine because they're full-time employees, but any non-full-time director would qualify as a person who cannot get 50% of the overall compensation given to the entire director pool per se, non-executive director pool. That's the only limitation, but beyond that, again, I think those are extreme rules that India has kind of created because of obviously some abuse at some point in history. But I would say these are the rules which you have to follow. It is complicated, and this is one of the reasons why in many of these new startup companies, the founders are not even called promoters. They have diluted themselves so much that they own less than 10% of the company when the company goes to list. in many cases 3 or 4% of the company. And then they're almost like, listen, I built this company, now I'm left with some 3 or 4%. What do I do? Well, the board says, okay, fine, we'll give you ESOPs and we will classify you as a non-promoter. So the board is allowed to do that. Unfortunately, some companies got into trouble because he's a promoter, but why do you call him a non-promoter? This kind of questions come to SEBI. And while every company does play by the rules, SEBI often can make it difficult because they play on the principle and rather not on the rule book sometimes, and that can become complicated for people who want to follow the rules per se, but the rules themselves are a little ambiguous.
Vashishtha, on this, this seems very complicated, and a lot of our conversation about stock options or ESOP seems to have just been about taxes, which doesn't feel like something either the company or the employee wants. But you've interviewed so many people over the years, and I think one thing you always come away with is people don't understand the options package that they currently have. So if you're an employee who's going to go and get a job somewhere, either maybe considering a job at either Capitalmind or is working somewhere and hasn't really ever paid attention to that options letter they got, what are some things you should look at that and be cognizant of or be aware of so that you can make the right decision about your options?
Same things that go into options pricing is look at what kind of a grant letter you'll get. How long is the vesting period? Is there a cliff? Is it 1 year, 2 year, 3 year, whatever it is? What is the expiry period? If you leave the company, will you have to exercise and will it lapse? The strike price, of course. And what is the FMB at that same time? Like if you're getting 500 rupees strike when the stock price is 1,000, that's great for you. If you're getting 500 rupees strike price when the stock price is 250, you're very out of the money. So you have to be cognizant of all these things. Other than that, it's not that complex in terms of once you understand the calculations. I think you have to be aware that how much you should maybe calculate some scenarios of what happens, say over the next 3, 5, 7, 10 years at different rates of growth, at maybe 10, 15, 20, 25, 30% rates of growth. What could be the price and what would be the value of your options on a post-tax basis? And how much cash flow you would need to even convert and sell those things. So if you keep track of those things, you will know that, up to maybe, I don't know, say 50 lakhs of cash outflow from my end, maybe I can afford to do it. So up to that point, you can, continue holding the options. But at some point when it becomes like, oh, this is growing too fast and then I will never be able to get the cash upfront to exercise it, you should start converting and keeping it into, converting them and keeping them as shares. So those are things that people need to understand. So not straightforward.
You say convert, but is the company just willing to let you convert and hold on?
Company has to.
Okay.
Company has no choice. Once it has granted the ESOP plan, company can't make it worse for anybody. They can make it beneficial for everyone. For example, they can extend the options by incurring the extra cost, but they can't make it worse for any one person. So once you have the option, companies on the hook. You have to honor anyone's exercise claim. But companies not on the hook to provide you a liquidity.
On that though, let's say you do convert and you're sitting with the share. You can't just go around selling it to anyone as well, right? If it's a private company.
No, it's a private company by definition restricts who the shareholders are. So you may have found a buyer, but the company may not like it. And the company can say, no, I don't want that person on my cap table. So company can say, no, I don't want to allow this transfer. And company has to approve the transfer. And a lot of, now that all the shares are in demat, I think this year the deadline was there for all private limited companies to have their shares in demat form. So now all shares are in demat form. In theory, you can go and do an off-market transfer to somebody and take the money, right? Without the company's approval. But the company, both the depositories, you have an IC at both the depositories. Both depositories send you a report every week. After, I think on every Monday you get it as of last Friday, saying who are the people who hold your ISIN. And in that, if the company is monitoring and seeing, oh, there's a new shareholder which we never approved, then obviously you can go back to deposit saying we never approved it, you have to reverse this transaction. So you have to do anything with the blessings of the board of the company. But to avoid these kind of situations, what companies now do, private limited companies, is they go to depositories and say, hey, why don't you put my ISIN on freeze? So it's called frozen for debit. So my ISIN is frozen for any debit from any demat account. So unless the company instructs the depositories to unfreeze it, which happens in 7-day cycles at CDSL, NSDL is open-ended, so you can keep it open. So if you do it for 7 days at a time, you say, okay, this is the window, it's unfrozen. In that duration, some people can transact, and only upon approval from the board. So that's how companies restrict it. These are two different things. There's no lock-in. So you're not restricting a particular person's shares. You're restricting the ISIN itself.
And in many cases, there's a difference between a public company and a listed company, right? So a public company is just one where you can go to beyond 200 shareholders, and there you can't disapprove the transfer of shares. However, in some companies like NSC, even a transfer of shares to a new shareholder requires the NSC to have vetted every single shareholder. So you need to provide like your, I don't know, some bunch of things. And the board has to go through it. Only then, so it takes a 3-month cycle to buy the NSC share the first time. So that is one layer. The second one is that even in a public company, I would suggest don't go against the founding teams or the management's wishes, because it did happen in a company like Reliance Retail, where IPO, not ESOP holders, had sold their shares to a bunch of other people, and in the private market the valuations were going at some crazy numbers, crazy rates. At which point Reliance, which is the parent company of this Reliance Retail, they own 98% of the shares. They said, guys, we want to just own 100%. This is crazy. You guys are valuing this company at some numbers which don't make any sense. But we can't offer that number. We'll offer you like 1/4 that number or something like that. And people are like, oh, no, I will sell my shares in the private market. How can you stop us? Well, it turns out they could, because all the valuation of this company that was Reliance Retail was because it was expanding, it was doing a bunch of things in retail, but there were also a bunch of acquisitions that were happening or going to happen at that point. Reliance just put another company called Reliance Retail Ventures Limited between. That became the holding company of Reliance Retail that held 98% of Reliance Retail. But all the new acquisitions were done now in the Reliance Retail Ventures company, which is one level above, right? So now all the value, if it is accruing to one level above, how do you value the one level below at the same? It doesn't make any sense. So people were, and then eventually Reliance did buy out those remaining 2%, but a lot lesser than what the market value was, and it came to an amicable kind of an agreement. But it wasn't the most favorable for people who had bought in the secondary markets at those high values. So I would say, in general, don't go against promoters for this, because at some point in time, you will find yourself on the bad side of the table on that side.
Okay, well, thanks, folks, for explaining all this. But now let's come to a question of how I should use these proceeds. So there's companies, many of our friends work at these companies. Some of them are our customers. They all expect to make fairly nice payouts some of them already have, and some of them expect to make them in the months and maybe years ahead. So let's say you've got lucky and you've managed to get a fairly good payout through your options in one of these companies. And now you're sitting on this cash or maybe some shares of the company public and cash. How do you invest this? So maybe this time I'll start. Deepak already talked about this a bit. So I'll start with Vashishtha.
Like I mentioned before, I think the riskiest thing you could have done has played out for you. So unless you are that person who wants to enjoy taking risks so much, you'll now want to probably take a more balanced approach to it and invest in a diversified set of instruments. Obviously, since we sponsor a mutual fund, and Deepak is the CEO of a mutual fund sahi hai, and I think they are the best, most tax efficient vehicle available today to invest with. And a lot of those proceeds should go into baskets of mutual funds.
Biased, but I hear your point.
I'll add a layer. Our mutual funds tagline is "Win at Life." So I encourage you, and in general, if you made a lot of money and you probably have met your financial goals, kids' education goals and stuff like that, paid off your loans or whatever it is, and once you've got there beyond that point, the rest of the money is actually yours to use, spend the way you please. And if this is the time you've made that money, go out and spend it. You don't have to put it on Facebook that you have, because that's like, that was the old Facebook where everybody was happy and spending money, mostly by loans. Now you actually have money, and this is the time you should go and enjoy your life. Do all those things that you wanted to do, but you were stopped because of the fear of having to spend all that money and therefore losing your net worth. Money is just a number. You don't have to be worth 50 crores all your life. You can be worth 10 when you die or 0 when you die. But in order to get from 50 down to 0, you're going to have to spend that money. So I think at that point, I really consider spending money and making your life better. Even charity is spending money in that sense, because it's money that's not going to come back. That's the definition of charity in the first place. So investment is one layer, and I think you should do that to make yourself comfortable, happy, secure. But spending, charity, the things that make you happy is also another big choice. And of course, if you're paying it, if you want to pay it back to the community, and I think of this as charity to a large extent, is invest in other startups who are early fledgling startups who might eventually give you some great amount of money back, but you don't want it because you're just saying, listen, somebody helped me when I was nothing, and I didn't, this is a bonanza for me, and maybe I should help more companies like us come.
So diversify your wealth, spend it well.
On spending, a lot of people make this from the ESOP, but they continue to have the job. So they have the net worth. The net worth, if invested at whatever, 4-5% real rates, so maybe 10-15% returns nominal, that is going to grow. Your net worth is continuing to keep going up. So you still have the income from your salary, which may be high at that time. So you can actually afford to spend the entire thing.
Okay. Well, this is not what I was expecting. Last, what about alpha? I mean, I've made all this money. Can't I park 10, 20, 30% of it and go after some great PMS or AIF or whatever, crypto fund or something?
To every single person who has come to the PMS having made money from ESOPs, my first statement to them is, I will never be able to generate a return like you just did, because you invested something and it gave you some ridiculous, I mean, you don't even know what you invested for the most part because it was an ESOP. But whatever you did, if I just calculated back, that would be some ridiculous, some 400% CAGR averaged, even to founders. There's no way I can meet that. At best, I will say 15 or 16% is what the maximum that equity markets have offered you in the past on a long-term basis. So that's about what your expectation should be. From 400% down to 16% sounds like a cop-out, but that's where we operate in the PMS and mutual fund space. But people in the founding space, they will make a lot more money just starting a new company if that's what their real ambition is, to make more money.
Well, that's our episode. I just have to say that the first time I had personally heard of stock options was in the year 2000 when I was visiting some distant family in the US, in California, the Bay Area. And I had seen people who had made money on stock options in the years before that and had now actually invested in buying beautiful houses, fancy cars. And that's the first time I became familiar with the concept. And now, what is it, 25 years later, you keep seeing that happen in India as well, where people make fortunes on options and, well, like everyone else, do end up spending a lot of that on cars and houses, but also other stuff like paying off loans, their kids' education, and so on.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.